How can you secure your financial future? Is it through diligent saving or smart spending? While these are important components, the linchpin of building wealth and securing your future pivots around one word: investing. Investing has a lot to understand, but it isn't complicated. Let's dive a little deeper into this element of finance. Investing isn't just about putting your cash somewhere and hoping for the best. It's a deliberate and calculated approach to multiplying your wealth. It is here that the power of compound interest comes into play. Often referred to as the eighth wonder of the world, compound interest helps your investments grow over time. Put simply, compound interest is when you earn interest on the money you put into an investment yourself, then you earn interest on the interest you previously earned, which accelerates the growth of your investments exponentially. With time, a small investment can balloon into a substantial sum. Now, diligent saving and smart spending are the keys to fueling your investments. Saving is more than just setting aside a part of your income every month, it provides you with the capital to invest. Smart spending, on the other hand, maximizes your ability to save diligently without sacrificing your quality of life. The money saved through these practices can be funneled towards investments, thus speeding your path to financial stability. Before we continue, this is part 11 of the Mind Your Money series. I'm Matt, and I hope this video on investing is helpful. Please consider a like, and click the subscribe button to see the rest of the series and other future uploads. Investment is a multifaceted discipline, with several distinct categories to explore. Firstly, we have the stock market, a popular choice among many. Here, one can invest in index funds, a form of investing that offers a more simple and often more profitable option than actively managed funds or individual stocks. I don't find individual stocks or day trading to be good options for most people, so we won't cover those here. Index funds work by tracking a specific index, such as the S&P 500, and offering a wide range of market exposure, low operating expenses, and low portfolio turnover. However, like all investments, they come with inherent risks, dependent on market fluctuations and economic conditions. Then there are bonds and CDs. These are essentially loans an investor makes to the government, corporations, or banks. They are often considered lower risk than stocks and can provide a steady stream of income. But the returns are typically lower, and the money is tied up for a set period. Following bonds, there's the real estate sector. This allows investment in both residential and commercial properties. The benefit of real estate investment is the potential for steady cash flow through rental income and substantial profit upon selling properties when their values have increased. However, market downturns can result in reduced property values and rental income, and management of the property can be time-consuming if done yourself, or expensive if you hire a property management company. Diversifying these traditional forms of investment, we have mutual funds, where your money is pooled with other investors and managed by professionals. This isn't too popular these days, and for good reason. Most often, actively managed funds do not outperform the stock market, and have a much higher management cost. This has made index funds a highly sought-after alternative to mutual funds, as they will often outperform mutual funds, while costing less. A win-win. Lastly, but certainly not least, are retirement accounts. These include 401ks and IRAs, which offer significant tax advantages. These retirement accounts allow for tax-deductible contributions, tax-deferred growth, and in the case of Roth accounts, tax-free withdrawals during retirement. However, they do have contribution limits and penalties for early withdrawal. If you withdraw money from these accounts before 59.5 years old, you'll have to pay those penalties. Investing also extends to the realm of alternative investments like cryptocurrencies and startups, which we won't get into today. Each form of investment presents unique opportunities and challenges, and it's crucial to carefully consider these before making any decisions. Investing can essentially be categorized into two types: short-term and long-term. These two types differ in their approach, the time horizon they focus on, and the kinds of investments they involve. Short-term investing typically involves the allocation of funds in safer, lower-risk investments over a brief timescale, generally with the aim of maximizing money growth. For example, this might involve investing in bonds or certificates of deposit. These are considered safe assets because they usually provide a guaranteed return, and they're not highly susceptible to market volatility. However, the potential returns on these investments is typically lower than those of riskier assets. This is great for funds that you're setting aside for a down payment on a home in a couple years, or money intended for other large purchases you intend to make in a short time frame. Allow the money you already have saved to earn some interest while you continue saving the rest of the amount that you need. On the flip side, we have long-term investing. This form of investing involves holding on to assets for an extended period, often several years or even decades, with the aim of building wealth and achieving financial goals. Examples of long-term investments include stocks, mutual funds, or real estate. These types of investments often carry higher risk as their value can fluctuate significantly over time due to economic changes, market volatility, and other factors. However, they also hold the potential for significant returns, especially when held over a long period. The belief usually associated with long-term investing is that, over time, your investment will grow despite short-term market fluctuations as long as you use grounded, well-thought-out approaches to investing, such as low-cost index funds with a long history of growth. Individuals tend to have a variety of financial goals that they wish to achieve throughout their lives. Some of these goals could be developing a robust retirement fund, setting aside savings for their children's educational needs, preserving their current wealth, or creating a constant income stream. The type of investment you choose can be heavily influenced by these goals. For instance, retirement funds and educational savings might benefit from long-term steady growth stocks or bonds, while preserving wealth could require a more conservative approach like government securities or CDs. If regular income is the goal, investments such as dividend-paying stocks or rental properties might be more suitable. Investing, however, always comes with the notion of risk and return. Higher risk investments provide the possibility of greater returns, but they can also lead to significant losses. On the other hand, safer investments may not offer as much growth potential, but they do provide more stable, consistent returns. This is where the balance of risk and reward becomes crucial. Understanding and managing this risk is an essential concept in investing. One of the main strategies to control this risk is through diversification. This means distributing your investments across various asset classes like stocks, real estate, bonds, and more. Diversification doesn't guarantee profits or protect against losses, but it does reduce the potential for a major loss that can occur from investing heavily in a single asset class. Don't put all your eggs in one basket and all that jazz. Index funds are an excellent way to achieve diversification. These funds aim to replicate the performance of a specific market index, spreading your investment across the entire index. For example, the S&P 500 spreads the money you invest over 500 different companies, making it diversified. This strategy offers exposure to a wide range of companies and industries, effectively reducing your vulnerability to market fluctuations. When it comes to investment vehicles, each has its own set of unique characteristics, potentials, and risks. Picking individual stocks, for example, can be a risky endeavor. This is primarily due to the volatile nature of the stock market, where stocks can dramatically rise or fall based on a multitude of factors. However, the potential returns can be substantial if you pick the right stocks at the right time. Again, this is something that the vast majority of people will lose money on when attempted. Index funds, on the other hand, are designed to track and match the performance of a specific market index, such as the S&P 500. Historically speaking, index funds often outperform even the best actively managed investments due to their lower costs and broader diversification. I know I've said this before, but it cannot be understated. Bonds play a critical role in a balanced portfolio as well. They offer a steady stream of income, usually in the form of interest payments. Furthermore, they can help balance out the volatility of stocks, providing a level of stability, as well as helping to pad your losses when the stock market goes down. Mutual funds and exchange-traded funds, ETFs, are investment vehicles that pool together money from many investors to purchase a diversified portfolio of stocks, bonds, or other assets. While mutual funds and ETFs have lost some popularity due to their high fees, they still have their merits. Mutual funds can be choice for investors who want a professional manager to choose investments for them, while ETFs can be a good choice for investors who prefer more flexibility in trading. These are things you may wish to look at later in your investing journey, when you've done more research and feel comfortable with some more basic forms of investing. Real estate investing is another powerful avenue for building wealth. It offers the potential for rental income, a steady cash flow that can provide financial stability. Plus, over time, the value of the property itself may increase, leading to property appreciation. Real estate is also often considered a good hedge against inflation, adding another level of allure to this investment vehicle. Creating an investment strategy is a process that requires careful contemplation and smart decision-making. It begins with defining clear and realistic financial goals. These could range from saving for retirement, purchasing a home, paying for a child's education, or even creating a home upgrades fund. Understanding what you want to achieve financially helps set the course for your investment journey. Then comes the assessment of your risk tolerance. This step involves honest introspection. Are you someone who can sleep soundly even if your investments dive one day? Or do you prefer the safety of steady but slower growth? Your answers to these questions are crucial in determining the type of investments that are right for you. This way you'll have strategy that matches your comfort level and financial aspirations. The next step in crafting your investment strategy is the allocation of assets. This is the process of dividing your investments among different types, such as stocks, bonds, and cash. The right mix depends on your financial goals, risk tolerance, and time frame. For example, if you have a high risk tolerance and a long time horizon, you might lean more towards stocks. On the other hand, if you're risk averse and nearing retirement, bonds and cash investments may be more appropriate. Lastly, it's crucial to understand that creating an investment strategy is not a one-time event. The financial market is a dynamic entity that changes constantly, and so should your strategy. Regularly reviewing and adjusting your investment plan as needed is just as important as setting it up. This ensures that you're on track to achieving your financial goals even as market conditions change. These are all things that many investment companies, such as Vanguard, have professionals ready to help you with. So don't be afraid to ask whatever institution you invest with, if there is someone you can speak with. The creation of an investment strategy is not about getting rich quick. It's about meticulous planning and diligent execution to build and secure your financial future. Rather than waiting for the perfect moment to start, the most suitable time to take control of your financial destiny is now. So, why wait? Begin crafting your financial plan today and take your first step towards achieving your financial goals.